Welcome back to another Jobs Report Friday. Today is the second Friday of the month, but because the last Friday of the month was the first day of the month, the BLS Jobs Report was delayed to this Friday. And with this Friday being the day after Jay Powell speaks, we didn't get any kind of extreme hawking. If anything, we got pretty neutral Powell saying, hey, we're not far from having the confidence that we'll be able to cut rates at some point this year. Although you've got other folks who are suggesting, hey, maybe the next summary of economic projections is going to suggest, hey, you've got maybe 1 or 2 rate cuts this year as opposed to 3. Who knows? But we do have a jobs report today that might help give us some guidance. What we'd be looking for in a jobs report that would be indicative of rate cuts coming would be some form of miss that is substantially larger than we would normally expect. I would say if we have, let's see, today we're looking for a read of 200,000. That's down from the January's crazy 353,000 figure. Really, if we're anything like the ADP report, which we almost never are, we'd miss by a little bit, right? The ADP report came in 10,000 low, so maybe we come in at, 175 to 185 over here. That's fine. That's not really going to be indicative of big cuts coming or anything. But what we might end up seeing is more rate cuts being priced in if we got something low in like the neighborhood of sub 150. I'd say sub 150 would be a pretty good opportunity to think there are some rate cuts there. We'll see. And kind of going to be entertaining. So we've got that coming out within the next minute or so here. And we'll be covering this. So let's take a look here in the pre-market. You've got Palantir up another 1%. You've got let's see here. There's no particular commentary I see here on why Tesla's up in pre-market about 1%. Don't see any spectacular news. If anything, there's just another hit piece here on Bloomberg. Wall Street fans turn squeamish with EV turmoil mounting. I'm just squeamish about what's going to end up happening with those delivery numbers. But Tesla is up 1.7 here in pre-market, 1.3 on Intel. You're looking at Nvidia sitting at 227 to the upside. Costco reported earnings and did miss on that top line revenue figure. So you are dropping about 4%. I kind of thought that they would miss, but I will say I didn't think they would run as much as they did before that earnings miss. But oh well. So let's take a look. So we've got the jobs numbers coming out in about 10 seconds here. So we're gonna pull the cues up, and we're gonna get into the 1-minute chart here. And here we go. 275 comes in hot again. And average hourly earnings, though, come in low at 0.1 on the average hourly earnings, which is actually lower than expected. Year over year, 4.3. Unemployment rate actually moves up to 3.9. That is interesting. So the unemployment rate is up at 3.9. So I wonder if our participation rate, the participation rate moved down to 62.5%. So slight move there on the participation rate. And then you've got that labor wage inflation figure at just 0.1%, which is actually pretty good. So it shows you strong economy, 275,000 jobs, and less wage inflation. It's pretty good. This is kind of what you would want to see. BLS labor report. Let's go take a peek here at the actual unemployment report in detail. So I'm grabbing that here for March 8th. We're going to go ahead and throw that in on our PDF reader here, and we'll get into some of the details of it. I'd say that's honestly probably a best of both, because you got that lower inflationary pressure with a stronger actual jobs read. 275. Unemployment rate increases to 2.9. Job gains were in healthcare, government, food services, social assistance, transportation, warehousing, and government. So it does look spread there. It's not just government and healthcare, at least from what we can see right now. It does look like the Qs are pretty happy about that. Look at that. You got a little bit of a rocket ship on the QQQ level here. But maybe we're a little too zoomed in. Up about 30 basis points. So you got some enthusiasm occurring here. Tesla's actually up to 2.6. Look at Nvidia, though. Nvidia just keeps moving on this. It looks like more and more money is just continuing to flow into the stock market, leading to sort of this prop-up environment that we're in, which seems pretty remarkable. You've got, let's see here. Household survey data, unemployment data rose by 0.2 percentage points. And number of unemployed increased by 334 to 6. Let's go right here to 6.5 million. A year earlier, the jobless rate was 3.6%. The number of unemployed was 6 million. Among major worker groups, adult women, teenagers increased over the month. Unemployment, that is, sitting at 3.5 for women, 12.5 for teenagers. Jobless rate for adult men, 3.5. Whites, 3.4. Blacks, 5.6. Asians, 3.4. Hispanics, 4.0. Looking at permanent job losers, increased 174. It's a little changed right here on permanent job losers. You've got, let's see here, number of long-term unemployed at 1.2 million, little changed. Long-term unemployed accounted for 18.7% of all unemployed. February labor force data participation was 62.5. That was a little bit lower. The third consecutive a month of 30. Oh, that was lower than expectations. Okay, so it's been sitting at 30, at 62.5. That is true. Yeah, okay, it was just lower than expectations. Oh, wow, we did have a revision on the prior read. The prior read, we went from 0.6% on monthly wages to 0.5% revised. So that's for January. So suggesting January wasn't as hot as expected. And then listen to this. January had 353,000 jobs, revised all the way down to 229. Huge revision there to the downside. Wow. It kind of makes you wonder how do you mess it up so badly? Well, I don't know, but yeah, okay. I mean, that's almost 120,000 negative hit on the revision there, but wow. Okay, these I'm taking a look here at what the suits are saying. Revisions look notable. December was also revised down negative 43. So we had a negative 43. So this right here is negative 124 for Jan. And then you had a negative 43 for December. So you had two revisions here. Treasuries aren't really changing here. 4.07, factoring in the downward revision for the prior months. Payroll gain is effectively less than expected when you factor in the revisions. And okay, let's keep going through the report here. Let's see here. Oh, those revisions coming through were a little bit of a bummer. Okay, let's see. In February, the number of people not in the labor force who currently want a job at 5.7 million was a little changed. Fine. Establishment data 275. Healthcare added 67,000. That's above the average of 58,000 over the prior 12. The government added 52,000. That's above the 53,000 average gain. 42,000 in drinking places and food services and drinking places. That's changed a little over the prior 3 months. Social assistance added 24,000, so another form of government, although the average there is 23. Transportation rose by 20K. That's after couriers lost 70,000 jobs in the prior 3 months. February job gains also occurred in air transportation. Retail trade employment little changed in February, as has shown, let's see, over last year. Okay, over the month, job gains in general merchandise retailers Health and personal care retailers and automotive parts up, slightly up, slightly up, slightly up. Offset by building material, losses in building material and garden equipment, electronics. Okay, let's see here. Okay, little change in other major industries. Average hourly earnings, we saw this was up 0.1% in February. This is trending better into the disinflationary narrative rather than inflation, or a sort of a second spiral. In February, the average work week for all employees on private non-farm payrolls edged up. Okay, we saw that. All right, we're going to look at some of the charts here. Specifically, we want to see the households data versus the establishment data. And what we're going to do is we'll find those answers in the tables. And we'll look at that in just a moment here. Let me see if they have anything to say in the meantime. Oh, okay. I thought it was on CNBC. Apparently, I'm not. Okay, I'm on. Nope. Okay. 8, 5. There we go. Somebody getting taken in over there. All right. Here we go.
I don't know how many immigrants are coming into this economy. The unemployment rate is a much better thing to look at. It's a ratio where you don't need to worry quite as much what the population size is. And the fact that that went up means we should be raising our inflation, our recession fears just a little tick. We should be lowering our labor market tightness fears a tick. And most importantly here over the last 3 months, wage growth is at a 4% annual rate. Last month when you were looking...
We did actually lose jobs in the household survey. So take a look at that. The household survey right here, it says employed. We're at negative 184,000. And then if you look at the civilian labor force, the civilian labor force is up 150,000. So the labor force is up 150K, but the employed was down negative 184. So that's interesting. I wonder if that sort of plays into what the gentleman there on TV was saying. So you have a labor force up 150K, and again, household survey down 184,000. Remember the difference between the two. The payrolls data is where you have the Bureau of Labor Statistics calling businesses and evaluating their how many employees they have. However, that could lead to double counting of employees, whereas the household survey calls individuals, though those are sometimes a little bit harder data sets to attain because, again, you're calling individuals. But in this case, we're down 184 on that household read. So this, let's see, the rates market is likely to focus on the higher unemployment rate and the downward revision. Although the labor market is far from weak, there is some indication that cracks may solidify the market's expectation of Fed rate cuts by mid-year. Let's take a look at where we actually sit with these rate expectations. Okay, so yeah, we're looking at March 20th, we're looking at a 94% chance that we're not getting any kind of rate cut. In March, that's pretty much priced in. There's about a 27.4% chance that we're going to get rate cuts in May, but it looks like we're going to have more of that likelihood come summer. You're at about 74.7% chance of getting those rate cuts in June. And then if you go to July, you're in the 92.4% chance. So really looks like we're setting up for June or July here. That really gives the Fed about, June 12th from now is what, 3 months? That sounds about right, gaining confidence, getting closer. Okay, that sounds realistic. Okay, let's see if Nicky T gave us any kind of commentary. He did. Private sector hiring was revised down. Yeah, looked right at that revision. Yeah, there's not much to make out of that post. Okay. I do think a revision was... Let's see here. These revisions, along with rising unemployment, will likely revive questions about how close the U.S. is to recession, especially given the historical coinciding of rising unemployment rate and recession. Well, yeah, the unemployment rate usually skyrockets going into a recession. But, yeah, those are some big revisions. Okay, so what else here? Some of the details look weak. You've got positive news there on inflation data. I'm not seeing the bond market really move in either direction on this. You're down 5 bips on the 10-year, and if I look at the 2-year, you are down 9.7 basis points. Well, that's a pretty good move. That's pretty good. Okay, so that's actually going to give us, yeah, some uninversion of the yield curve here. Let me look at this. 210. Let's pull the 210s. Okay, 210s. We sit at negative 37 basis points. Okay, cool. So, how's the market reacting to this? Well, you've got Palantir up about 1.93. You've got the Qs up 24 bips. Tesla up a couple. Nvidia up a couple again. This feels like Nvidia's up a couple all of the time. You're at 951 there. That's wild. 182. Tesla. Enphase is up a couple percent. ARM was red pre-market. Goes green again. You've got... Let's see here. Apple, even Apple's up 72 basis points. I think it's just lots of money that is available that needs to go flow somewhere. Let's listen in to see if they've got anything to say about this.
With stable inflation, but is, with this month's report, edging a little bit closer to it as well.
Rick, just one more question. We did a report yesterday on CNBC. We were out at a pub in New Jersey and talking about the $15 minimum wage we now have in I guess in parts of New Jersey. And the guy said, I don't hire full-time anymore. I can't afford it.
You just read my mind. Yes, you read my mind. That one of the issues with part-time, and Jason is right, historically. But see, we tear up the historic playbooks post-COVID. Everything's a little odd. We're in kind of the twilight zone with regard to employment. So I would say there's a lot of truth to that, especially when I look at some of the local burger joints in my neighborhood that have closed. They saw a surge in business. You still couldn't really get in. All of a sudden you go there and they're gone. Some of the bigger ones seem to be doing better. I think they have a little bit more firepower when it comes to hiring.
All right, we got to go.
Did you get to the bottom of it?
Screaming in the... It's so much nuance whenever and it seems like the nuance is increasing every jobs report that we do. We got to think about more things, right? It gives me a headache, kind of.
It's not as clear because we're.
You just want to get rid of us. Go back to more
Jason,
fun.
I miss you.
Roger Ferguson coming. That's why.
Jason, I just like when we're asking you questions because as a professor, you guys get this huge head because you're bossing all these kids around all the time, and
And I make them laugh at my jokes, which I can't really make you do.
Thanks to our panel, Sarah, Jason, Joel, Rick, and Steve. I don't have to thank Rick and Steve, but thanks anyway.
You're welcome. When we come back, much more on the jobs report and how it could play into the Fed's upcoming interest rate decision, how they're seeing all of this. For that, we've got former Fed Vice Chairman Roger Ferguson. He'll be joining us right after this. Stay tuned. You're watching Squawk Box, and this is CNBC.
Gee, I wonder what he's going to say. Oh, patience. Patience, grasshopper. Anyway, Apple doesn't seem to care to be patient. Up 77 basis points, 25 there on the Qs, and almost 3% now on Nvidia. It just keeps going. Okay, so jobs, household. So just to recap, we got on the household data, we got 150,000 person increase in the labor force, but the household data showed a loss of 184,000 workers. The pay, what's it called? Not the household ones. the other one, the payrolls survey, jobs payrolls data, that one showed 275,000 jobs versus the expectation of 200K. However, January revised down, what do we got? 124 was it? Yeah, 124,000. And December was also revised down again, revised down 43,000. But the big banger here in the number, which was great, was that the average hourly earnings month over month, those moved up 0.1% versus the 0.2 expected versus the 0.6% January, which was also revised to 0.5%. Okay, cool. That's a summary of the jobs data. Boy, Steve here says, look at gold performance in relation to rate cut cycles. Look at price of gold now, and we haven't even started. Ooh, gold, eh? U.S. will need to start printing money again while inflation is still high. Second wave coming. Buy gold. Steve demands you buy gold. Gold right now is sitting at almost 2,200. It's at 2,185. Got stuck there for a while in that sort of 2050 level, little trading range there. So quite interesting. Okay, then let's see here. We are going to, let's see here. Fed swaps now fully price in a quarter-point cut in June. Not sure about that, but I think we're at 75% on that. So I don't see it fully priced in, but we'll see. Sometimes it takes a little moment for some of this data to update, so we'll see. Let's see, that is, yeah, to be determined. Okay, let's see what they're saying right here, and they've got a former Fed person that's going to do some yapping on this jobs report.
Former Fed Vice Chairman Roger Ferguson. He's the former president and CEO of TIAA and now Vice Chairman of the Business Council and a CNBC contributor. And Roger, let's look at this. 275,000. The street was expecting 198,000 in terms of jobs. The unemployment rate, though, jumped to 3.9% from 3.7%. You had big revisions, I think, down 171,000 from that huge number we saw in January jobs. Participation rate unchanged at 62.5%. Average hours for the work week, 34.3 from 34.1. Take all of those numbers, mush them up, and feed them into the Fed machine. What's the analysis that you spit out?
Look, I think at the end of the day, the Fed analysis is so far so good and still sort of no rush to cut. So what does that mean? So far so good. Things have not fallen out of bed. Yes, the unemployment rate ticked up a little bit, so have your antenna up a little bit about recessionary risk, which I think is always important. On the other hand, the revision suggests that maybe that outlying number in January was a misstatement. And so I think what this ends up with is basically where they were before, which is there's room to cut at some point this year. Inflation pressures do seem to be continuing to go down. And so I think they look at this and go, pretty good report, keeps us on the path that Jay Powell laid out over the last couple of days of congressional testimony.
I would agree with all of that, except for one phrase that Jay Powell used yesterday in his testimony. He was asked a question, and he basically said, they're waiting to get more confident that inflation is moving sustainably at 2%. When we do get that confidence, and we're not far from it, it'll be appropriate to begin to dial back the level of restriction. I mean, we're not far from it. What does that mean to you?
What that means to me is likely not a move in May, but probably a move in June. I think they're going to want to get one more meeting to make sure they feel that degree of confidence. And, June has always been, in my mind, when they're likely to start to move. And that's what I heard when Chair Powell talked about getting confidence, not far from it, et cetera. Seems to me like that gives them room to move at mid-year, which was, I think, always the most likely outcome, even though the market took some time to get there.
Jason Furman was just making some comments. He suggested that the higher tick in the unemployment rate, 3.9% now versus 3.7%, is an indication that the economy is weakening. He pointed out that not only the data that we're looking at is a little outdated, but also that the Fed's tools take a little while to work. He worried that if the Fed doesn't cut rates by May or June, then you are risking getting into a recession.
Look, well, first, I some time ago when this episode started, I indicated that I was worried about a recession risk. You heard Chair Powell, I think, yesterday say that, in fact, if they delay too long, there is an increased risk of recession. None of that should be news to anyone. I think we're still talking about risk to recession, but more likely outcome is soft landing. So a tick up in the unemployment rate to 3.9 is still well below what one might think of as recessionary levels. It's still a sign of a strong economy coming back into balance. So I think one can have it both ways. And Chair Powell said it very clearly yesterday. Let's think about a risk of recession. We want to avoid that. We don't think we need to crush the economy to what we want. And consequently, being ready to move May or June, and I think June slightly more likely.
We had a very interesting guest earlier this week who said that if the Fed does cut rates as the market expects, I mean, he pointed to the new highs the stock market averages keep setting. He pointed to speculative things like cryptocurrencies and gold prices taking off as all signs that there's still a lot of liquidity out here. And if the Fed actually cuts rates into this liquidity, that it's going to be game on and the markets will be off to the races. Does the Fed worry at all about that?
I think the Fed is certainly interested in what they think of as sort of financial conditions, which is all the stuff that leads to forward momentum. Absolutely. I think, on the other hand, it's a little hard to know exactly what's driving the market because the markets are forward-looking. There's expectation of a Fed cut. So one might argue that if the Fed cuts, it's just simply validating what the market already expects, and it's not a sign that it should be off to the races. It's rather, oh yes, the market anticipated correctly.
You could
and
say
is
that's a
valued the
sign
right
of
way.
feeding the addiction, though.
You could say it's a number of different things. There's no doubt about it that the market is highly sensitive now to interest rates for sure, slightly different than it has been in the past. But on the other hand, look, the Fed has one job to do, well, actually it's now a dual mandate, inflation and unemployment. And they're working hard to thread that needle towards that soft landing. And if the market then sort of takes off, they may have to adjust a little bit. But it shouldn't be the thing that drives their thinking, in my opinion.
Roger, thanks a lot. Always appreciate getting your
Interesting. All right, so don't focus on the market, focus on inflation. Inflation coming down. All right, let's take a peek here. Let's look at some of the biggest movers here, and then we're going to look at a few earnings here. Carvana, New York Community Bank going back to 4, Super Microcomputer at $1,200, Nvidia is up 2.9%, Enphase is up 2.5%. Wow. Palantir up at $27 now. All right, so let's take a peek now at Costco. Costco did report earnings yesterday, and those earnings did miss. Top line revenue missed, and I want to see what was in their earnings call as well. The stock did start moving up a little bit in pre-market here as we got the jobs data as well. I think the stock was down about 4%, and you're sitting at actually 3 price target increases for Costco. So if we write down for Costco, we've got Morgan Stanley, Jefferies, and Raymond James all raise price targets on Costco to 870, 905, and 820 together there respectively. Wow. And then you have let's see here. Costco Q2 forecast. Hold on a sec. No, sorry, they're in Q2 now. Okay, this wasn't their forecast. Just Q2 general. I don't think they gave a forecast here. They don't actually see an outlook. That's interesting. Yeah, no particular outlook provided, but I do see Q2 EPS beat at 392 versus the 362. And if I look at total revenue, Q2 total revenue, we missed by 4.4%. That's roughly also around where the stock fell before we got the jobs numbers today. So, yeah. Okay, good. So then I think we got Marvell as well. Ooh, that sounds funny. Marvell. Ooh, let's see here. Okay, yeah, here we go. Q1. Let's see, it was their forecast was less desirable. Looking at Q1, loss per share of 18 to 28 cents per share. EPS forecast lags. Forecast? Okay, so a little bit of a miss there at Marvell, but you're still getting price target increases. All of them. Benchmark, Raymond James, Piper Sandler, Susquehanna. All of them. Price target increase, increase, increase. It's kind of crazy. The market's just like very, very enthusiastic about everything. You could get misses, and you'll still get price target increases, even if the numbers are coming in a little red initially. So let's see here. What is this? Oh yeah, we got Rivian's vehicle yesterday. Let's take a look at that. So that was the R2. Yesterday was also the State of the Union, which obviously we covered if you didn't see that yet. Made a summary as well. R2 revealed yesterday at $45,000, though the vehicle won't launch until first half of 2026. And I mean, that's obviously a much more competitive price range. Let's see. Yeah, okay. So what I always like to do is look at the capacity for that happening. I'm going to pull up the Rivian earnings really quickly. Let me see what this person says while I pull them up.
3 to 2 is going to be hard. Now, they may round up and say it's 2.9 and we're going to call that 2, but to get to the Fed target at 2, I think it's going to be a while. We don't have CPI going below 3 for the whole year. In the last month or so, we've seen everything pretty much start to tick higher. You know, in the food complex, energy, and obviously the metals as well, copper.
You only like a Fab 4 out of the 7, and would you rather do the Fab 4 out of the 7, or would you rather broaden out to the Russell? Quick answer.
Here's the thing. we do like the Fab 4 versus the 7 just for different reasons, but I think there's some broadening out. You know, we like the Russell 2000 on the growth side. We think growth's going to be the spot that you want to be. You want to try to find areas that haven't grown a lot. But I think most people are U.S.-centric. I think you can look outside the country.
Yeah, well, there's China. So net cash and operating activities on the year over at Rivian sat at about $5 billion. And in terms of cash flow, saying negative $5 billion there. You do have capital expenditures of another $1 billion, so your free cash flow is negative $6 billion. So that puts you at about negative $500 of free cash flow per quarter. And that I mean, your net loss figure did fall a bit, but the problem with Rivian was your loss per quarter got worse in the fourth quarter compared to the prior 3 quarters. That could be because of end of the year expenses, material orderings, bonuses, whatever. But obviously, we've got a company here that still has to get their margin cleaned up. We increased cost of revenues. This will be an interesting set of math. If we divide cost of revenues by the prior increase of cost of revenues, or rather by the prior level of cost of revenues, we're at about 35% increase. Revenues, though, despite that cost of revenue growing 35%, revenues grew 2.6x. So that'd be growing about 167%. So that's a good sign, right? Because when you have cost of revenues growing at a slower rate, so write that down, right? Cost of revenues growing at about 35% for year over year 2023 to 2022. Cost of revenues, that's COGS. And revenues growing about 167% year over year 23 over 22. Then at some point, if you keep having that positive delta between those two ratios, you should be profitable. So for example, let's grow revenue here by, well here, we'll throw it on a spreadsheet really quickly for Rivian. It'll be a little easier. I'm always a fan of, if you're going to use the spreadsheet for stuff, you can generally quickly make a new spreadsheet. It's very tough to have a calculator for everything, always updated. All right, so this is how simple we can make this. We're going to go revenue 4434, and we're going to go COGS at 6464. Now, year 2024, year 2025, year 2026, that's when they want to do that cheaper vehicle. So what I'll do is I will multiply this out by some growth rate. Let's go with, for here, we could go with, where's my formula? And, oh, they got rid of the formula button. They just put it under insert now. How interesting. Okay, so we grow it by, let's see, they grew at 167. Let's just say they double, right? They double revenues for the next 2 years. So we'll go with, right, there we go, 200%. Okay, double revenues, let's just say. And then we're going to increase our COGS. Let's keep it at the same level just to see the difference. So I've reduced the revenue growth rate a bit. And what we're doing is, we are increasing their COGS by 1.35. There we go. So now, come on. Let's actually do our math. It's too early to do this kind of math here. That's the problem. There we go. Okay. So now, let's take a look at what we have for Rivian. Are we profitable with those numbers? Yeah, look at that. You actually turned profitable in 2024 with those numbers. So you subtract revenue by COGS. Gross profit is negative. Gross profit turns positive. Gross profit turns vastly positive. Now, of course, let's assume their COGS keep growing at 135%, but their revenues don't grow by 100%, especially since they're forecasting flat growth. Let's grow revenues by just 150%. So slightly more than their cost of goods sold. Well, if we do that, it's going to take us until year 2027 to be profitable. And in 2026, they expect to release a cheaper vehicle, so that could delay their profitability a bit more as well. I think what will happen with Rivian is you'll have a company that says, hey, as long as we're trending towards better profitability, please buy our stock. And people will probably do that. That was probably going to happen. And that's not necessarily a bad thing. It gives Rivian runway. It gives them the opportunity to raise money if they need to. All right, so we're going to look at what the suits are saying in just a moment. But first, we'll start with what Jimbo has to say this morning.
It was really downbeat, except for his one part of optical with AI. And the stock was down 10 and it finished down 4. Hawk 10 in the middle of his conference call, they were Broadcom. The stock was down 40. Then he mentioned that they're going to do $10 billion in AI. Right. And next thing you know, it's like, boom.
Versus 7.5 prior. Sienna was the other name earlier in the week, Jim, that talked about legacy weakness in enterprise and telcos, right?
Look, that's just the service provider telco business has gone away. Look, there's companies in that business, AT&T, Verizon. They've spent their years trying to not have to spend any more money, and people keep waiting. It's a Godot situation. Don't look at the symbol. It's much more of a work of literature. But I like to keep him up these days.
No, I know. I'm okay on my Godot.
Oh, thou swell, thou witty.
I'm all right. Not great.
But I just find that if you mention AI, this is the problem. If you mention AI within anywhere involving your company, it's just a license to have your stock go higher. And I think that, David, that's what I think is. I mean, Carl, look, we've had these times where I remember in 2000 when there were companies, great companies like WorldCom. They were doing fabulous things.
Yes, there were. I would not in any way compare what we're seeing today with what ultimately was, to a certain extent of their business, fraud.
No, but I think that when I look at Everard Murrow's piece on Senator McCarthy and David's piece at the gym at the basketball court with Bernie Evers, those are really it.
There were definitely some moments there. There's no doubt.
I'm not sorry to be so reverential. It must be like your birthday or something. I feel so.
I appreciate that. But back to the semis. I mean, listen, nobody or few people doubt the power of this moment in terms of AI and generative AI, what it's going to mean, but it doesn't mean that these stocks may not be a bit ahead of themselves, Jim. When again, I'm starting to hear I'm a little, some concern out there about just this momentum trade.
Well, look, I mean, Ben Rice is from Melius, who's really had the great beat.
This time is different.
AMD. Well, I mean, if you look at the chart of AMD, no one was really writing off.
Nobody
AMD.
seems to be writing it off.
Because he hikes his target by $70 today.
I know, and I sent him a quick email saying, congratulations, because he does have a beat on things. But I'm going out to see Jensen. I'm making what everyone is calling the pilgrimage. At the same time that
the 18th, right? Yeah, exactly. Oh boy. Oh, is the 18th going to be the greatest sell the news day ever? Who knows? That would be a very interesting trade. Think about that. The 18th, you've got the NVIDIA event. And then on the 20th, you have the Fed event. So you've got this sort of double warning or potential sell the news. I mean, you're going to get the summary of economic projections as well in March. Boy, those are going to be glorious. Mostly because, now we'll have had January data, we'll have February data for inflation and jobs. That inflation data comes out next week, mind you. So we're looking at the inflation data. CPI is expected to come in at month-over-month at 0.4 and month-over-month core at 0.3. We're looking for, obviously that to hopefully miss slightly. That would be desirable. But let's take a look at this. Here's a Bank of America, we're not far from it piece. And this is an interesting phrase here. $6 to $7 trillion in money market funds, and all of it getting 5% interest. Maybe that's what's given everyone confidence to go speculate. That's funny. NASDAQ bubble peaked. Note that semiconductors relative to the S&P 500 hit their highest level since March of 2000. That's interesting. That was in 2000. NASDAQ bubble peaked. Semiconductors relative to the S&P 500 hit their highest level since March of 2000. But again, folks, this time is different. Hard landing probability very low. Soft landing 75%. No landing at about 20%. U.S. quits rate still declining. Fed funds rate there at peak. Let's see here. What to know? Let's see. Abnormal times, abnormal gains. Stocks ferocious, up 25% in 5 months. Has happened 10 times since 1930. Normally, such surges occur from recession lows or the start of bubbles. Oh, wow. Stretched and extended. Short history of bubbles shows it can go further. Fed causes bubbles and Fed pops bubbles. And in 2024, the Fed's determination to cut rates means we're not far from it. Yeah. Let's see here. Yeah, this is just sort of an observation of some historical ratios. Biden's best asset commodities versus stocks for Trump's. That's interesting. Sort of a little political difference here. Look at that. Biden's best asset commodities. Worst asset Trump commodities. That's interesting. Best asset. Government bonds have been a bad asset for Biden. Let's see what else here. Biden real estate was the worst sector versus Trump energy. worst commodity for Trump was oil. Hey, that brought gas prices down. But, you know, that's also so macro dependent. Payrolls, 225,000 is no landing if we get over 225. Oh, we did. So must have written this right before. 175 to 200K soft, under 100K hard. Yeah, well, we got 275. So I guess that puts us in the no landing number. Yeah. Yeah, no, the dot-com era was wild in terms of like bubble numbers. These are like, the numbers now are like, oh yeah, money's flowing into songs. Oh, by the way, the price goes up on the event today at 1 p.m. So if you want to be in by 1 p.m. on the June 21st event in Vegas, check it out at meetkevin.com. All right, so what do we have here? We have a page that is not loading. Okay, that's entertaining. Oh, how interesting. Let me reload that. Hold on a second.
Anything out into the atmosphere.
Musk is brilliant. I just feel like that when you look at what's happening with Letter X, and when you read the truncated emails for Sam Altman, you have to say that this man is a tad distracted, plus a $1 billion arson in Germany, and then
a tad distracted? Elon a tad distracted? Oh, that is very generous.
From the time David sat down with them, the Tesla shares yesterday, lowest level since May, Jim. And Jonas's note this week is interesting. Toyota, he wrote, which has zero exposure to battery EVs, is going to gain more share in this country than any other OEM.
Well, look, Toyota has the possibility of the miraculous 10-minute charge that we're all waiting for.
10-minute charge.
10-minute charge. Well, look, this is a high-stakes
Is that
game.
like the super energy drink? Yeah, kind of
The
like that,
5-hour
right?
energy, the
5-hour energy,
part of the
10-minute
hostile
charge.
takeover that took the Street.com away from me after 25 years.
What was the connection between 5-hour
they now
energy?
own it.
Really?
Yeah,
Same
the guy
guys?
owns it. Yeah,
well,
he
that,
owns it.
that goes to
David,
show.
the synergy there and the
I see
artificial
it.
intelligence they use to find all sorts of new reporters makes me feel terrific about the legacy that I've cemented.
As you should. As you should. Yeah.
One of the
Feel
great
very
periods of
good
my
about
life
that.
was devoted to a quarter of my life was.
All right, there we go. I got that back up. Somebody here in the chat is asking, how much room is left in the check mark? Well, okay. So here's my thesis. I think that the Fed's March meeting could sow some uncertainty as rate cuts are delayed. I think the numbers that we got suggest rate cuts get delayed. So there's a short-term answer and there's a longer-term answer to this. Okay, so let's write this out. Okay, this is the thesis. So the short-term answer, we're gonna write that down. And let's see here, short-term answer. Okay. So the short-term answer is March 20th. SEP from Fed can't risk being too dovish as financial conditions would loosen even more. Okay, so let's see where financial conditions sit right now. Let's get those. 1 second. Goldman Sachs financial conditions. Oh wow, they just fell again. Yeah, that's what I'm talking about. That and that exactly is one of your problems. I will post what that chart looks like in just a moment here. But here, financial conditions index last year. So I'll put up the last year. We're now clearly at the lowest point in financial conditions in a year. And that's not great from a Fed point of view because, again, the Fed is worried about the risk of undoing their inflation progress. I don't think there's going to be a second wave, right? That's my opinion. So that'll come into play in the longer term. But when we look at, oh, that's really interesting on the 5-year. Okay, I'm going to pull out the 5-year as well. So longer term, I don't think inflation is really the issue, but I don't think the Fed wants to risk that. So I'm going to write this down. 1 year Goldman Sachs Financial Conditions Index, and then I'm going to throw up, I'm going to throw up the 5-year as well. 5-year Goldman Sachs Financial Conditions Index. Okay. So obviously financial conditions are expected to be higher on the 5-year, but that's because, you know, the Fed's trying to do a job of crushing whatever inflation is left. The fact that they got rid of FATE, I think, is a very bad thing. I think it really just, it slows down your progress towards lower rates and sort of waking the Fed up to this idea that, hey, maybe there's a risk you're going to go too far. Remember, Fed rate cuts usually take the escalator up and the elevator down because they end up breaking something. So if I go jump into ehack.com, where I've now posted these, take a look at this. This is the 1-year Goldman Sachs Financial Conditions Index. And as you can see, we've just collapsed. We are at the lowest level in a year. And the Fed wants this to remain somewhat tight, right? So that means in the short term, we have this risk of a Fed doing whatever they can to stabilize this collapse, right? So I'm going to write Fed in short term wants to stabilize this collapse. Likely, okay? Obviously, on the 5-year, we're still high, but so is inflation. Obviously up, but so is inflation. And we're not that much above 2019 levels. Look at 2019 levels. In fact, if you take this dotted line right here, follow this dotted line, ignore COVID right here, because, I mean, this is obviously COVID, panic, and then this is, you know, stimulus, right? So ignore COVID for a moment. Just go back to the 5 years. We're about to be at a lower level in financial conditions tightness than in 2019. That might lead to a little bit of a hockey-docky Powell, at least a hockey-docky board. So fin conditions as loose as 2019 might lead Fed to hawk March 20th. That's my take. So what does that mean? Well, and the removal of FATE, right? So what does that mean? In the short term, I think you have short-term risk of some form of a sort of Fed-induced short-term panic. There's a possibility of that. And I think longer term, so if I go long term, I think you have more of a risk of disinflation. So I think over the next 10 years, let's write this down. I think you'll have lower interest rates than before the pandemic. Now this is my opinion. I know there are a lot of people who don't agree with that, but to me, what does that say? That says long-term buy rate sensitive stocks and buy real estate, right? Real estate especially. I mean, y'all know I have a housing startup. Like, maybe I'm biased because I have a housing startup. We're fundraising, by the way. Read the PPM over at househack.com/2024. And warrants are due if you haven't heard that yet. But anyway, I think y'all already know that. But I don't think I'm biased because I have a housing startup. I think because I believe this is the truth, I created a housing startup. Like, I want to create a housing startup in you know, when I think the time is perfect to do it. You know, we launched the business in the summer of 2022, and I think we are going to be pretty bang on here with timing. Things are going very well, and there are a lot of opportunities out there right now because a lot of people are you know, short on cash. So those create opportunities. Less so in single family at the beginning of this year right now. There's just way too little inventory. I saw some comments here about somebody writing what's it called? Somebody trying to write offers on single family and getting outbid. That's solely the lack of inventory. Once we start getting more inventory and that price discovery, I think you'll see more stability. I would expect that inventory in April and May. That's usually when you see more sellers. See, most buyers buy in March and April. Most sellers sell in June. So you have like this stupid mismatch. But that's very normal because everybody's like, oh, honey, we're going to sell the house this year. And nobody wants to really list in January, February. Then they call an agent in like March because they're like, yeah, we want to be part of the spring. And the agents are like, well, your house needs to be cleaned up. And then by the time the sellers, the owners actually get around to doing it, it's May, you know, and then they got to get their pictures taken and stuff. And then, yeah, May, June, I think is where you see some inventory. So short answer, I do think there is some downside risk here in the short term. I mean, think about the short term. And I understand this is trading, right? Like long term, you don't care. You go in, whatever, you buy the dip. The problem with buy the dip is if you don't have any money to buy the dip and you've just got one set of money, you don't want to hear that because you don't got new money to play with. So short term, March 20th is a risk. And the SEP is probably going to be more hawkish than we expect. But then again, if the market is already expecting it to be more hawkish than we expected, then that's already priced in. I do also think you have short-term issues in Tesla. And it's unfortunate, but I really want to prep people for a bad Q1. I don't know that Q2 is going to be much better. I think 2024 might be a flat to nominal growth year. 2024, I expect flat to nominal growth, but I think that's your bottom. And, if that's the bottom, it's probably a bottom. If that's a bottom, then maybe you're back to 30% growth thereafter as rates become a tailwind, right? So interest rate sensitives will have a huge tailwind for two reasons. One, rates coming down slowly. Two, actually three reasons. Low comps. And three, low relative valuations. I think that's something to consider. So I think you have the time to buy the interest rate sensitives is probably between now and May. You might, though, wait until after the Fed meeting. That Fed meeting could tank the interest rate sensitives. We'll see. It'll be very interesting to actually see what happens. But that's a theory. So, and also keep in mind long term, I think long term 30-year fixed rate mortgage is under 1.8% in 2032. Like, you should tell your phone, like, hey, S word, remind me in 8 years that Meet Kevin said the 30-year mortgage should be under 1.8%. And then write me a letter or leave me a comment. Hopefully you're still watching. But yeah, I think that'll be very interesting. Let's see here. Okie dokie. So what else? Did I my little banner down here, did I write? No, it doesn't say 2023. It says June 21 to June 23. I mean, I could make that more clear by saying June 21 to 23, 2024. There you go. Ah, yes. Solved. There. Anyway. So it has been noted. You sound just like Siri. That's funny. There's a rumor Tesla bought 100 million of Bitcoin in Q1. It might be profitable through crypto. You see, but I don't really think that fundamentally matters. Like, I don't think you should invest in Tesla because in one quarter they pulled off a good trade. I think you should invest in Tesla because you think, it's your personal decision. I'm not actually providing advice for you to do that. I'm just saying, like, if you're an investor in Tesla, the reason you're an investor in Tesla is because you believe that EVs are the future. It's that you believe that Tesla will have the best margins. It's that you don't believe that Chinese competition is going to destroy you. It's that you don't believe that Elon is distracted, and you believe that EV charging infrastructure led by Tesla doesn't remove Tesla's moat. Instead, it provides more revenues for Tesla, and that you believe interest rate sensitive stocks will do well when rates start coming down. In the meantime, it'll probably just be Nvidia. The thing's up like 3% every day. It's mind blowing, but great. I mean, I I can't get mad at it. I got exposure to Nvidia too. Palantir, Nvidia, got exposure to them. So in a good chunk. So I'm not mad. It's wild to see how excited the market is. It's kind of incredible because it goes through these emotional roller coasters of being so pessimistic and then being so bearish. So a very interesting cycle, so to speak, of ups and downs. Yeah, Palantir has been really great. Yeah, I added a Palantir at like $18.50, and a lot of people actually got mad at me. They're like, how could you buy Palantir at $18.50? And I'm like, well, me thinks it's going up. Well, no, obviously from a fundamental point of view, I see Palantir is one of the best actual AI plays. Kind of like Tesla, except Palantir actually monetizes their AI. I think Tesla, frankly, needs to drop the price of full self-driving substantially. Like, they shouldn't be dropping the price of the car. Should just, like, include FSD, my goodness, and stop dropping the price of the cars. I don't know. The upgrade nonsense to FSD, I think, just leads to a low enthusiasm level because people are creating this cost-benefit analysis and they're just not interested in trying it. So, all right, we're 2 minutes from the bell. And then we will cover the bell. Let's see what else we have. Okay, what are the suits saying this morning? Well, there's a piece here in Doomberg. The outlook for Elon Musk's Tesla has been darkening rapidly, with demand for EVs continuing to decelerate. This week, the backdrop worsened further as data showed competition from Chinese car companies getting fiercer, and the German factory getting halted. Adam Jones, who is one long-term bull on Tesla, thinks that Tesla could actually lose money this year in its auto business. Ooh. Well, let's listen into the bell and we'll keep going with suit comments.
Participants across 8 countries, and to your point, Jim, showed that particularly with patients in earlier stages of the disease, experiencing very strong results, is the way Lilly puts it.
That's the surprise.
In terms of benefit.
Yes, and I think it's important to point out that this was not a criticism which would have set it back. It's much more of a, we have to do more panel. Now, I think one of the reasons, David, this would stress the system, it's that big. They really have to have this thing down because everyone in America who had any Alzheimer's will demand this. So they have to have this thing down. So I still expect it to pass. I am surprised it did not get the okay.
Let's get a look at the opening bell here at the big board at State Street. A global advisor celebrating International Women's Day. Having done a little event.
It's like 60% green there. All right, so we got some green coming in. We've got Costco, Dumpy Doodla on the Costco. Down 4.2% here on the open. Does look like the Qs are uncertain of their direction. You've got Nvidia's got a red candle here. Tesla's uncertain of direction as well. Nvidia now turning red. Okay, we just had Qs. Lost the lead on the Qs. Good selling pressure here right at the open. Palantir selling pressure. You've got Enphase, though, has a green candle. So Mind Medicine up some more after yesterday's pretty crazy rally there on some preliminary FDA approvals. Apple's pretty much flat, slightly green. Walmart's down with Costco. Sympathy on Costco. Intel up another 73 basis points. Trade Desk up 70. C3AI is 2.2%. Still don't like that company. Etsy's up 73 basis points. Marvell falls 6.3%. Costco's continuing its acceleration to the downside, 4.6. The Qs, unsure which direction they want to go here. Tesla's got a nice red candlestick. I think if short-term guessing would have it, I would say your best buying opportunity is after either the earnings report or delivery figures. I think both of those are going to be bad. I hate to say it, but delivery figures always precede the bad earnings report. See, like, when there's good news, it's in the delivery figures. And then the earnings report already prices in the best case scenario of margins, but then you get a worse margin in this environment. And so you get double bad news in this sort of time. In the future, that'll flip, I think, to double good news. Like, you'll actually have lower costs, higher prices with lower rates. And so like, the long term, I think you got some beats, but I think in the short term, there'll be some buying opportunities for Tesla. I don't know how low we'll go, though. You know, right now we're bouncing around the Fibby right here. This is a pretty strong support. I'm a little concerned that and I'm glad we didn't get a full candle break here, but I am a little concerned that the first week of April delivery figures will drop us below 175, and that's probably going to lead us to this downtrend bounce of around 150 to 148. Again, I hope not, because I think that's painful for people. You know, there are margin call risks and stuff, and hopefully it's wrong, and hopefully we just sort of continue to teeter up here. But we did break this uptrend here, so that failed again, and we're well below the moving averages here. So that's something that I'm watching. Costco now down almost 5% on the day, continuing to get some either profit taking or what here on Costco. Nvidia wants to move up instead. ARM slightly negative. Palantir continues its 3% gain. Enphase sitting at 2. And Disney is basically flat at 110. AMD at 80 bips here. And the Q's sitting at about 15, trying to recover there. So we'll see. Okay, good. Now, let's see what some of the other El Pseudos are saying. El Pseudo Myrudo. I don't know what I'm saying. Okay. Oh, yeah, here, with Tesla. There was this piece in Doomburger. So I usually like to be contrarian against what some of these folks are saying, but 20 out of 59 analysts have buy ratings right now. So most of them bearish. One buy analyst, Adam Jonas of Morgan Stanley, he was the guy who started pricing in like Dojo before Elon pooped on it. Thinks the company could lose money in its auto business this year. RIP. This is going to be a challenging year for the EVs. Jonas wrote in a note that he expected Tesla's profits for the first half to miss expectations, and margins could be in the red. Wow, red margin. That's bearish. Could have red margins in Q1. Remember the Model 3. I'm going to make a little note of that. Recall the Model 3 did lose its $7,500 tax credit Jan 1. And that was offset by a partial price drop of about like 4K or something like that. So then you've got big decline. Let's see here. Tesla's the biggest decliner in the NASDAQ 100 this year. Wow. Tesla is the biggest decliner in the NASDAQ 100 this year. Wow. That's crazy. Dropping almost 12% this year. Obviously, you've got a little bit of like a 1% bounce right now. Many experts thought electric vehicles would be broadly adopted by now, but the reality is still they're fairly new, and the charging infrastructure is still not fully built out. Material gap between consumer perceptions. And then people are arguing that investors are concerned about the timing of and implementation of full self-driving software, price cuts that seem to be never ending, and a relatively rich valuation. Those are the three things they're arguing. So I'm gonna write that down. So the valuation, it's really tough. So let's touch on that really quick. Price cuts, FSD slowness, and then of course valuation at 59x PE, and that's going to be forward for the end of the year. I think that's because we're sitting at about $3 of earnings. Yeah, that makes sense. At 180, that's about $3. And so the problem that you have to figure with Tesla is the PEG ratio, right? So if average growth for Tesla for 4 years after this year is 20%, then PEG is about 3, right? And if the average growth is 30%, then the PEG is about 2. And really, you probably want to be around 6, 7, right? So I'm going to write that down. If you want a PEG of around 167, let's write that down. If PEG should be around 1.67, then, and let's assume 30%, and assume 30% growth, even if this year ends up being flattish, then where do we need to be? So 30% growth, let's see here. Okay, I'm going to play with this for a moment. Let me see here. If I go with, I'm going to draw that out. Give me a second here. Let's listen in here for a moment, and then I'm going to draw this out. Oops.
Everything that David said is the problem with Silicon Valley, because these numbers are not apples to apples to any of the Eastern companies. So I totally get where he's coming from.
I mean, Costco is just pretty straightforward.
Costco.
Like, here's what we made. Here's what it cost us, and here's our earnings.
Oh, and there'll be people on the call who question Rich Galanti on something, and like Rich says, let's take the next call. Basically just saying you don't belong in this club. You flunked.
He'll be missed. Meantime, Jim, some stories on the tape about Huawei's innovation.
On the backs of AMAT and Lam?
And it's due to used equipment that China's gotten their hands on out of LRCX.
I know.
And
Rick Hill
AMAT.
built Lam, too. He sold that to the Novellus, that combination. Lam. No, look, here. They did comply with the old rules. There's $2 billion of business that Lam lost, that LRCX lost to China. So it's not like they're, David, they're playing by the rules. But the rules came in a little bit later. And meanwhile, Huawei's got the knockoff phone. And now, David, there's a see that? Yeah. This is where the actual intellectual property lies. This is how you make.
I'm getting 150. So this is just quickly the math that I'm pulling here. So PE is price to EPS. EPS is 3. Let me just verify that. It's the forward EPS, because that would change the figures here. EPS, yeah, for the end of the year is $3, $3.05. Okay, so I'll perfect that. So if I have price over EPS, $3.05, over, because remember, this is a PE ratio, right? This right here, that is equal to the PE ratio. So if that's equal to the PE ratio, and it's divided by the growth in EPS, the growth rate, that's how you get the PEG ratio. Well, if we want the PEG to be 167, then we can multiply by 30, so we get 50. That's basically a PE, right? 30% growth times 167, that's PE 50. That makes sense. And so if you want it to be 50 with $3 of EPS at the end of the year, well, then I'm just going to go 305 times 50.1. And at a 167 PEG, if you're to go that low, you're sitting at about 152, which is interestingly right where the TA sits. You know, that's right where you have a TA point. So that's an interesting observation. So find that very interesting. Take a shot every time I said interesting. Costco down about 6% now. I wish I just shorted it the day before earnings as opposed to a month before earnings. But I did short this sucker, and then I got stopped out. I had a feeling they were going to miss on earnings, but I started way too early. So anyway, down 5.6 there on earnings. The Qs up 10 basis points, 2% on Matterport. Sunrun's up 3. Dutch Bros up 1. Dutch Bros has been interesting lately. You've actually seen kind of a look at that bleed out on Dutch Bros, huh? So Janet Yellen saying right now the economy is performing better than any other economy around the world. Carvana goes up another 9%. Holy smokes. Rivian up 5% here. Where's Rivian? There it is. Yeah. Oh, Rivian's in the little toilet down there, though. Jeez, Lord. Even with it being up 5.8%, you're still at the lowest level you've basically ever been for the stock. How's hims and hers? They're actually doing decently. C3 AI. I don't even know what this line is for. Let's just get rid of this. Stupid. Okay. Affirm's up 5 at 38 bucks. Look at that no man's land rejection there. Oh, Intel went negative. That's a surprise. I think Intel's a good one. You know, a lot of the stocks we look at I think are cool. Robinhood trying to come back to rob the hood. Up at $17 hollers. Enphase is up a couple percent. ARM's up 41 bipply doodlaws. Oh, look. It's almost there. It's almost there. It went to 958. My Fibby says 969. Holy crap. Wow. The next fib after that is 1116. Y'all, that's freaking crazy. Yeah, I did an analysis on hims and hers in the course member live, which we're going to be going to soon after I make another cup of coffee. So, NVIDIA Unstoppable. I mean, they make lots of money, you know, and like there's an easy way to fundamentally say they're great, but I don't know, man. And that growth rate is not going to last forever, and you're going to have a big fat negative growth rate, and people are going to go, man, this was supposed to be a growth stock. But they'll still have great margins. That's the thing. They'll still have great margins. Even when their growth falls, they'll still make lots of money. So if we get a confirmation of lower CPI, the expectation is now a June cut is most likely. So I'm going to write that down. Let's see here. So this I'm going to write here. We're going to say the suits think if we get a benign CPI report next week, rate cuts will come in June. Okay? And then I want to wrap my theses here. So I'm nervous going into March 20th in the short term, as well as, so that's the Fed meeting, as well as sell the news on NVIDIA's 18th event. I think the summary of economic projections from the Fed will suggest a cautious/hawkish stance, so less quick to cut rates. Long term, let's say by 2025, we start seeing some of this. But long term, interest rate sensitives, you get tailwinds. You get basically low comps, low relative valuations. Oh, I should put in the short term as well, the thought we just did about Tesla. Price should be 152 at $3.05 EPS and PEG of 167. Okay, so we got that written down. That aligns with, so a 150 on Tesla aligns with that downtrend. Downtrend that began, I would say, the trend really began in July of 23. And we've sort of been bouncing off that downtrend. So I think it'd probably be a quick bounce if we hit that. That might be a quick bounce, though. Okay. So that's my TA there. And then long-term, low comps, low relative valuations from interest rate sensitive, and obviously lower rates. And then, of course, real assets. Real assets, like real estate, should win long-term. Hashtag not personal advice. Okay. See, I gotta say not personal advice because I am a financial advisor, but I'm not your financial advisor. Okay, cool. So, what else? Let's see. Anything big here? I mean, we're almost at 69K again on Bitcoin. That's really going to lead to a nice little breakout. It looks like most things are relatively stable here. Marvell's obviously down about 7%. Not great. You've got Stellantis down 38 bips. You've got the triple leveraged Qs up a little bit. Lemonade really wants to rock it today. 5.6. And the Qs really aren't going anywhere. I wonder what's weighing the Qs down with Nvidia up so much. So is it Apple again? Let's see. Apple. No, Apple's up. Is it Microsoft? Yeah, Microsoft's down. Goog's up. Meta. No, Meta's up. So, all right. Well, we shall see. So, cool. I think, what else? Is that all I got? I think so. So, with that said, I guess we'll see you later for a good old video, and let's push the button and get this course member live going. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. Yeah, remember, if you haven't yet, June 21st to June 23rd, get your event tickets. The price goes up at 1 p.m. today for Vegas. It's going to be pretty sick. Teach real estate, finance. We'll have some innovation talks with some really cool speakers. So pretty excited to see y'all there in person. All right, folks. We'll see ya. Have a nice week.